And joining me on the podcast, of course, live in video, it's Paul back from his holes. You've had a bit of time off, haven't you? But you never take time off in the market. If you are a 100% investor like you are, and me, who have a passion for it, you never really take time off in the market. And in fact, the only thing that can keep me sort of sane on holidays is the ability to have Wi-Fi and internet to check the markets. So have you been away, haven't you, somewhere?
Yeah, no, I had a rainy holiday up in the Lake District. So yeah, that
was
was
it? Yeah,
that was good fun. But we were on the banks of the Derwent Water, and I had a couple of sort of like press releases on the companies that I tracked closely, which came out. So I wrote a couple of things up for investors, but I class that as entertainment rather than any work. And I know I was speaking to a couple of the companies at the same time. But no, I'll give you some updates on those. But yeah, I had a great holiday. I mean, and for my wife, she works at the school, so I have to have all my holidays and the school holidays when it's prime time. But it wasn't too busy because it was tipping it down.
Yeah. Well, that's annoying if you want to go abroad as well, because the price of holidays, literally, they just hiked. And in fact, we go to Centre Parks quite often, but you see almost 2 days or 1 day either side of the holiday, it goes up by £800. It's like, it's just crazy, It's great. Yeah, but do you know what? Part of me, though, I find holidays hard work, because I think when people holiday, they holiday from a job they're okay with. I love what I do and what I say. Why am I holidaying from that? It's like, so I do it for the wife and the kids, really, but I can't stop checking the stocks and shares prices. In fact, let's talk about macro starting off. Bank of England yesterday, of course, raising interest rates by the forecasted, quarter of a percentage point. What's your thoughts, Paul? I mean, do you think? I mean, I didn't really listen to speak. I saw Andrew Bailey say something about he won't, reduce interest rates until he sees prices solidly coming down. And these words, solidly coming down. What's your thoughts?
Yeah, I mean, I think he's doing. I mean, to be honest, I think he's doing the right thing now. I mean, he clearly didn't do the right thing before that when he was stimulating the economy, when we were having a whole lot of fiscal stimulus on the same time during COVID, because he kept all interest rates really low and that stoked it up. But the UK is in a pretty unique position in terms of sort of control inflation. You've got roughly a 3 print or 3 handle out in the States. You've got a 5 to 6 handle out in Europe, and then you've got obviously a 7 to 8 handle in the UK. And the difference between the UK and Europe and the US is, firstly, we've got the worst of all of their characteristics. We've got the energy shock and the supply chain shock of Europe, and we've got the tight labor market and the ongoing demand for services of the States. In Europe, they haven't got the latter, and in the US, they haven't got the former. But we've got both, and that's why our inflation, particularly wage inflation, is sticky. And I've said this so many times. Until we can see wage growth coming down it's around about the 2 to 3% level, then I think he's going to continue to hold interest rates high for longer, and that's what his projections are going to be saying. Yes, that's going to be bad for mortgage holders and companies that have lots of high borrowing, and it's a blunt instrument. But I actually think the big picture is, if you don't get inflation down, we're going to have a much tougher outlook longer term. So I think it's unfortunate, but he can't not do it. So you just got, as an investor, we've just got to plan. I actually think the bigger news, which didn't get as much sort of airtime on this side of the Atlantic, was actually the downgrade by Fitch of the US. Now, I know people are saying it's political and all this sort of stuff, but something I haven't heard, which is I'm concerned about, is they do now seem to be, the credit rating agencies, getting a bit belligerent in terms of countries and probably corporates as well, who have overstretched their balance sheets. And if that's the case, we're going to see a series of credit downgrades. I mean, let's be clear about it. I would not be surprised if they downgraded the UK. We're not exactly, if they can downgrade the US, they can downgrade the UK. And if they downgrade the UK, they can downgrade a lot of corporates as well, which makes it tougher on borrowings. That's my bigger concern. Is this a one-off in the States? And I just can't see it. Or is this actually going to be a bit of a trend? And I think we've just got to watch out. And if we start opening the sort of fiscal spending budgets ahead of ahead of the election next year, I could see them doing the same here as well. So
So what is the fallout from that then? So credit becomes more expensive. People will obviously borrow less, less expansion, less growth. I mean, that will help inflation come down even faster, won't it?
Yeah,
mean,
but it will
do
lead to
damage.
a tougher recession, won't it? I
Yeah.
mean, you'll get to where you want to get to quicker because you'll go through a recession. But frankly, more people are going to be made redundant, and we're going to have it's going to reduce people's spend. And rather than having a flat economy, which I think the bank economy is saying, very sort of like non-existent GDP growth for the next 2 to 3 years, then we're actually going to go negative. And I think that the US could do that as well. But hey, that doesn't mean stock prices haven't really reflected that. I mean, we've talked about that before because I've been cautious on the macro, but actually quite positive on small caps. And I'll talk through a few of those today. But coming back big picture to the macro, I am actually quite concerned in terms of this belligerence of the credit rating agencies and what that could actually mean if they start having knock-on impacts elsewhere into other countries and into large corporates, because essentially we've been everybody's been spending money like it's been free, hasn't it? And it has. That's the problem.
Yeah, the thing I'm slightly concerned. Maybe they have to talk a bit tough, the Bank of England and all that, and the Fed. But I am worried about this, lag effect. I mean, if you see, some of the inputs coming in, for example, the producer price index is in negative now. It's fallen off a cliff, and that leads into a lot of things. There's many things that are getting less worse. And so I'm just thinking, hang on a sec, let's just wait and see, because I think, like, again, they overstimulated at the front end, and now they're over tightening at the back end. That's what I think. What's the harm in waiting and pausing for a while before you do too much damage? Like I said, you want to achieve some kind of soft landing, but they don't know what kind of landing is it in for at the moment.
The
but
problem, with producer price inflation, it's largely relating to goods. Yeah, and goods, we know inflation's been coming down just on the base effects. But actually it's stabilizing. Look at the price of oil. That's sort of like, stabilized around that $70-80 per barrel. Commodities are stabilizing as well. They're not coming down any further. So you're going to need that base effect. The benefit is going to drop out. It's going to leave you then with core inflation, which is services. Strip out food and goods and just look at core services. And what is the biggest cost of services? It's wage inflation. So if you push the clock forward a year, 18 months, if we haven't nailed services and wage inflation, if it's still running at 5 and 6%, then that's where CPI is going to be, because we're not going to get any more benefit on PPI or on the goods. That's the problem that the central bankers have. They can see what you're seeing, but actually that they're looking more in 2 years' time. Is inflation core going to come down? And if we don't nail wages, the answer to that is no.
It sort of will come down, won't it? Because there'll be no demand. People don't have any jobs. There'll be plenty of people to hire.
That's the argument between soft landing, no landing, or a hard landing. I mean, I think most people are sort of like thinking that it's going to be, or hoping that it's going to be a soft landing, and the sort of like the view of that is as such that they're going to hold all the central bankers going to hold it until they see the wage inflation coming down, which is then going to turn the economy down. But before the economy turns really seriously down, wage inflation will cool off, and then they'll cut interest rates, and that will help the economy stabilize and boost.
And then they'll stimulate because the risks are going too far.
Boost the stock market. But it's a really big.
Have you seen Spain? What Spain's doing? It's like they're not just relying on interest rates. There's a lot more other measures they're doing. For example, they did put their energy caps lower, but they've cut sort of wage inflation, all that stuff, and they've done a lot more. And then now inflation's at 2%.
Yeah, so the difference between Europe and particularly the Club Med is that their unemployment rate is still 10%. It's very tight in Northern Europe.
Spain's youth unemployment rate is one of the worst in the world.
Well, there you go. But what's the unemployment rate in the UK? It's less than 4. That's the issue. We have the problem with the UK. We have that combined tight labour market, high demand for services, which is not what the Club Med type countries have. And we have that supply shock. There's the oil still coming through from oil and gas and from Ukraine. So we have the worst of Europe and the worst of America. We haven't got the benefits of either.
What have we got the best of?
Exactly. So
I think the stock markets. I think the market. I think some of the stocks on our market, honestly, there's some cracking little stocks.
Yes, agreed.
Really world leaders, and a lot of them are small as well. But like I said, it's a stock market, it's a market of stocks. So there's always a bargain to be had. There's always a winner in the market somewhere. So let's focus on
Okay, well, I'll give you one. I'll give you one. I mean, I caught up after my holiday with exec chairman Tony Gott of Saietta, who do these, sort of like next generation e-drives for electric vehicles. And he's had two interesting pieces in news out whilst I was away. First of all, they've got this third major platform with their OEM out in India. And this gives them another big contract in the light duty vehicles, 60,000 units, 12,000 per annum minimum on top of the 80,000 already. And the supply, he was telling me in the interview that the supply chain is now fully sort of like set up, and it's just finishing touches to go live with the deliveries at the back end of this year. And they'll have first vehicles out the door early 2024. And that joint venture is going really well. They're focusing on that sort of like the light vehicle. They've got the three platforms are covering all of that sort of like sector of 3 to 4 wheelers. They've got the sort of like the passenger transport of sort of tuk-tuks and vans and stuff like that, small vans. And then they've got the sort of heavier vans, the big transits as well, where they do radial flux and axial flux motors. But they do the key differentiator, which is their winning proposition, is they do these e-drive solutions, which you've got the motors, the e-motors, you've got the gearboxes, and you've got the controllers on top. And that gives them that perfect fit, whether it's modular as well, so they can tailor it to the customer, and they can improve the time to market. So that was a great contract win. Plus, the other piece of news which came out on Tuesday is that they've reformulated their partnership with Comet, which is the heavy duty truck, gives them a whole bunch of cash and reduces their cash burn, which is great going forward. And then the other third and final thing he mentioned on it, was asked a bit of a cheeky question, was how he was getting on with the outboard motors. And that is sort of like a bit on the sort of sidelines, because he's got so many priorities and inbound actually sales queries for that light duty that's going to come in the fullness of time. And he didn't tell me, but I suspect that could be sort of like licensing opportunities as well. But also what was really interesting and really encouraging to me, I mean, he reckons they're going to be EBITDA positive early next year, which is absolutely brilliant. It would be transformational for the business. They should have enough cash to get them through. They'll start hitting with their, those deliveries, knocking the deliveries out. And as I say, one anecdotal piece of evidence which I love is that this is a relatively small company playing with some really big industry players, so it's a great endorsement. And now they're getting the sort of get onto the world stage of these e-drives, full motors and gearboxes and control systems. So they're really effectively punching way above their weight, and they're in prime position next year, and the shares are very, very good value.
Yeah, well, do you know what? It's they've had a sort of a good problem to have, I suppose. They started off, firing on all cylinders, and they've had some, scale problems essentially. They've got a lot of people wanting their stuff, and they have to focus on, the nearest revenue generating parts of the business, and that's the Far East and all that stuff. But everything else is still there. It's not like they can't do it. They can do it, but with a small company, you've only got so many people to work on so many things, and so you have to prioritize, which is a good thing. I don't understand that share price went up and come back down on that news. And I saw someone, in fact, I haven't seen your video yet. I'm going to watch that with Tony Gott. But someone did comment saying, I'm going to wait until I see what their cash levels. Maybe that's it. Maybe people just worry about cash. But the fact they're going to be EBITDA positive is good, I think. But yeah,
they're getting that cash injection.
Yeah, and all companies need to focus. You can't just expand in every direction. You haven't got the resources or manpower.
And the logic for going for the light duty, the passenger, the 3 to 4 wheelers rather than the heavy duty. Just think about it. The infrastructure build of charging points is really developed in a lot of the parts of Europe and increasingly in India and increasingly with Teslas out in the US and stuff. Whereas if you rock up to a, sort of like a petrol station for trucks, it's still diesel, isn't it? You just on the motorway on the M6. I was doing it when I was coming back from the Lake District. I mean, you don't see a charging point for electric truck, do you? But whereas you see hundreds of the damn things in the, the service stations for cars. So that is why it's the near-term opportunity. And they're on these 3 major, vehicle platforms. And that's going to only expand. I mean, he was pretty confident he was going to sign some more sort of OEM deals as well in the near term over the next few months. And these literally could be 5 to 10 years sort of like, platforms, because that's what vehicles, for. And on that basis, I mean, who knows how many he's going to sell. I mean, I would say if he gets onto those, they could be well in the millions. There's no doubt about it, of units.
Yeah, it's amazing. It is a transition that's happening. We can see it before our eyes, and that's why people should have. I said on on the live show, everyone should have some exposure to some kind of renewables or energy in some way, because it's not going away. It's only getting bigger. Like I say, service stations. You go back 5 years, how many charging points at service stations? And
yeah,
now,
exactly.
And in 5 years' time, what would it be like? It'll be more. And so you have to look at that. And in fact, I'm going to tell you about an investment I made recently. I just saw it. What? And they've gone through a bit of trouble, strategic updates recently, and then they've had two sort of really experienced investors come on board and offer them sort of convertible loan notes. But it's and the news is quite. If you look at the news today,
which company?
I'll tell you now. But
you got me on a tender hook, there. I'm on the edge of a seat.
First of all, talking about renewables, right? The first turbines are being installed at the world's biggest offshore wind farm in the North Sea. The size of the thing is huge. So once complete, the £9 billion Dogger Bank wind farm will be more than double the size of the next largest offshore
I know what you're
farm.
talking about now.
Yeah, so 6 million and a small company involved in that. Again, very good technology. Is Tekmar TGP, and if you look at their last interim results, and they've gone, like I said, they've had some strategic problems. They did sort of up sale, and I've seen this happen many times in the last year or so. Companies struggling, and more often than not, you don't get anyone come to the rescue. But two very experienced guys have come to the sort of help and rescue of this company, and it's worth looking because they've got contracts everywhere. And the thing that struck me when I looked at them, and I'll just give you, what are they? They are about 16 million market cap. Okay, the half-year results up to the 31st of March. I saw this. Right, so 16 million market cap. First 6 months, they did 17.7 million, which is up from 13 million last year. But they did say at the end, expect the business to break even at an adjusted level for the current financial year, with revenue in the region of 40 million, over which 90% is already secured. A record order book of 26 million at the end of May 2023. And so that's interesting. And if you look what they do, basically, the offshore energy and marines division provides a range of engineering services and technology to support wind farms, basically, and all that. And if you look at
I think two-thirds is wind farms and a third is oil and gas, but they do that critical sort of electric connectors, don't they, to take the electricity from the wind farms onshore.
And they do subsea sort of protection, subsea cable protection, and it's called umbilical and flexible pipe protection systems. So they're involved in all this. So in fact, the guys that come on board are involved in wind farms as well. But so they're very much in the heart of this. I can't see this slowing down. And just the maintenance on these there's huge, these wind farms.
Oh, yeah, and it's years and years. I mean, just to give you a bit of, I mean, this is news to me, you see, because, not live, but it's sort of like, I hadn't heard of this one, as in like, you just bought it. But I've spoken to Alistair McDonald, the CEO, or exchanged emails. And I think he's a class act, and I think they're really well positioned to benefit from that. And one sort of like read across, one company that I think they'll probably sort of copy is Ashtead Technology. Now they don't do what these electrical connectors, but they are servicing the offshore wind sector, and they've done really well since IPO.
Oh, Ashtead, one of the
exactly. So I can see them doing. I can see them doing exactly the same, because they'll start getting on these really long sort of like development programs for offshore wind. Yeah, I think you've chosen well.
Yeah, well, I just saw the level of revenue they're at. The fact they've gone through a period of changes, but two really experienced people come on board, and also just look at the outlook as well. So 40 million in revenue, 90 of that is already secured, EBITDA positive, and they said the effects in the outlook. The effects of existing legacy contracts on margin begin to diminish in full year 2023. And as a result of improved contractual and commercial discipline, the board continues to expect business to generate positive EBITDA in full year 2024. Just heading in the right direction, in the right sector. They've come from a difficult period, so the share price is really down and taking a hammering, basically. So I just think, it's maybe taking a while to play through, but I think it's a good company to be in. And so, I'll sit and hold that.
Well, it's a massive long-term secular tailwind, that, isn't it?
Yeah.
No pun intended.
Yeah, exactly.
So I think I'm with you. That's primed to do well, and it's it's a long way off its all-time high. I can't remember what it was, but it was probably about £1 at one stage.
Yeah, but do you know what? I have bought. Let's look at the chart. I have bought small stakes. Reason why I bought small stakes in two other companies that sort of in the sort of med tech area. I'm not going to say them now because I can't get a position in them, and if I do it, other people will probably jump in. And literally, next time we meet, definitely I'll talk about them. But you know them quite well. But yeah, I think if you look at Tekmar, it's like 160 a share.
Yeah. Well, I look forward to touching base on that one in a couple of weeks' time. One you might want to put it, which is again difficult to get into, just because it's a sort of it's newly IPO'd and still owned by a lot of insiders, etc., is Fadel Partners, which just came on, the market in April. It raised £8 million at 44p. It basically it's a category killer. Software developer in sort of rights and royalty management, which is it's sort of like its older area that it's done, and that's growing at sort of like double digits, etc. And that serves the likes of Pearson, the publishers, and also people like Hasbro, the toy maker, and it enables them to do lots and lots of sort of allows them to automate all of their sort of royalties in and licensings in and licensings out to partners. So for instance, if you're Hasbro, for instance, and you make a whole bunch of toys, there might be lots of sort of like, T-shirts and hats that people want to have of Monopoly or Transformers and all this sort of stuff. So it helps all those, other third parties to collect those royalties and manage those royalties when they're actually, you need to. And Hasbro, for instance, has got $500 million worth of royalties coming in, but equally it licenses stuff in from third parties. It might do for, games for Disney or for other major media channels. So it has to pay out the royalties. So this automates all that process and integrates fully with the ERP system. So this is really niche software. And just to give you an indication of how...
What's the ticker on that?
FADL. It's Fadel Partners.
Okay. Yeah.
But they're... And I think they're about 30 million.
30 million market cap, yeah.
Market cap, yeah. They do turn over roughly around about $14 million for this year, but they're growing overall at around double-digit rates. And in fact, actually, I think, because this is a really booming area of sort of like, digitization of images and royalties and stuff like that. And if you think about, Pearson, for instance, that's even a bigger opportunity because they effectively have to pay a whole bunch of royalties out to authors for books, whether it's sort of educational or whether it's, sort of, recreational reading, etc. And that could be on subscription models for, from Spotify or from all these other, sort of stuff. And that makes it really, really complex. So this basically, as I say, automates it. And the retention rate is just incredible. They've only ever lost one client in 18 years. So it's like, it's just phenomenal. It's just one big, recurring and, renewal trends. That's sort of like a big chunk of their business. And then the other part of it is, which they have really sort of, another faster growth is called brand vision, which allows sort of like people like Coke, etc., to control all their images for their businesses around sort of the internet, etc., to make sure they're all consistent, and anybody licensing it to make sure they're consistent. It also has a huge content library that allows people to use those with all the relevant approvals corrected, and has also it's got some really unique software that scrapes the internet for anybody sort of like abusing it. And if you think about sort of what's happened with generative AI, you've got all of these sort of like picture creation platforms that just scrape images from everywhere and create it for people. Well, that's going to break IPR, and their software is going to alert it to the brand owner to actually crack down on this, particularly where it's abusive, or alternatively, they should be collecting some money on the back of it. So it's got these things, both of them have got huge ROIs. They're moving to, they're mainly a sort of a SaaS model. The brand vision is more of an out-the-box type model. There's more implementation involved with the standard sort of like, rights and royalty management where they have services. But they had a trading update, and 80% of their revenues now are recurring or support. It's software, and the software generates sort of gross margins of sort of 70% or so. And the service is only about 35% because it's more the sort of implementation, getting people on board. So they're moving more towards that sort of recurring revenue software model. They're quite sort of heavily second half weighted. They did about 5.5. I think it was at $5.3 million first half, and they're going to have to do sort of like 9.3 second half. And that seems like a stretch, but actually they have good visibility over that through just normal renewals, which is more second half. They've got this a product launch for their brand vision, which is really gaining traction. That's already happened, and that you can really benefit in the second half. They've got the new sales team now really sort of like motoring, and they've got, you know, they've got other sales they've just won as well. So when you put all that together, they're confident on their second half. And if that happens, then I'll give them a really strong exit run rate into 2024. And I actually think, you know, they could do high teens organic growth on the back of this over the next 3 or 4 years. Particularly from 24, 25, when that sales team, which they've used the IPO process to recruit, really sort of starts to kick in. And you've got to remember, this is just high recurring software business, and it actually reminds me very much of my investment in active ops. And I haven't, you know, I've talked about this one before, and
they've done quite well, have they received it as well?
Well, that's it. By
the way, but Fadel, it's one of those things you read and you realize, of course that's needed. I didn't realize that kind of thing existed, and then you realize, of course that's so needed. And it's one of those niche areas that companies can do very well if they, you know, grab a nice little share of the market. But a brand compliance and rights and royalty management software provider, I've never heard that. And that's of course you got big brands. How do they keep an eye on all the rights that due to them and their brands and all that? Yeah, of course it is. It's you know, it's a major.
It's a category killer as well. I mean, like, if you're in the industry, you know, Google dominates search, Uber dominates ride sharing, and actually Fadel Partners dominate, you know, rights management in this sort of niche area, because they're mainly competing against old legacy in-house systems that have been around for 20 years. Because nobody's really sort of got their hands around it and invested in it. I actually could see these, you know, in 5 or 6 years' time. I mean, I did ask the founder, Tarek Fadel, you know, what was the sort of long-term opportunity? And he's you've got $14 million of turnover for this year, but he's sort of like, the next 5 years, organic going to go to $50 million. That's organic, i.e. no acquisitions. And then with M&A on top, he's targeting 100 in the next 5 years. And if you just look at the organic and did a sort of 4 to 5 times multiple, you get $200 million to $250 million sort of, you know, enterprise value. And then you'd look at it sort of like, you know, you divide by 22 million fully diluted shares, you get around about £7 to £9 a share compared to what, 150 at the moment. And that's why I say it's a bit like active ops, this one, because it's a highly niche, you know, sort of specialist software. Active ops, you know, as I've invested in, etc., has been difficult to get into. It's been, you know, in a liquid stock. This is a similar liquid stock. I've made 50% on active ops, but
done well. Broke out nicely
and that's why I think it's 18 months behind active ops in terms of getting to EBITDA profitability and cash generation and getting to critical mass. But you can, but if you get in early, then I think you're going to see that, you know, it's going to be, who know, you know, you have, you know, any sort of like a liquid stock, things can go up and down as people sort of like move in and out the shares. But I think of the long-term trajectory of this is a dominant player in what it does. There's no doubt about it. And there's very few real serious competitors. They tend to be point solutions, which don't really do the whole sort of like, you know, satisfy a big corporation like the likes of Hasbro, Coke and Pearson's and people like that, who need something that is really going to, you know, do everything. So the one thing to note in terms of liquidity, it is a Reg S share, which what that means is it's been listed by a US based company, and therefore it stops US citizens buying the stock for 12 months. The problem you have with certain brokers like Hargreaves Lansdown is they haven't got the back end systems to distinguish between a US citizen and an English national who can buy the shares, and therefore they don't offer the shares on their platform. Whereas AJ Bell and Interactive investors have that distinction. They can separate out the US investors, and therefore they allow it to be purchased. So you have to choose your platform. But
yeah, well, I think I've had that problem with one of these companies I can't mention at the moment. That's why
okay.
it's literally. So yeah, I've had to literally go to a different platform. I with Barclays stockbrokers, I had to go to a different platform. But yeah,
I love the stock. I mean, I chuck big money into companies. It took me a long time with active ops, no doubt about it, but eventually managed to do it. And it was hard work. But as I say, I think they're on the same sort of thing. And the other thing which was really, interesting and comforting was when I spoke to Tarek. He's a very unassuming guy. He started this business 20 years ago from scratch, and he's brought it up with big players. I mean, we're talking like enormous corporation brand owners around the world, and he loves it, and he sees this as sort of like a part of his family, and it is. And I think
he's a founder then. I mean,
yeah, he is. Yeah,
so that's always, like I say, I keep referring to that because one of the traits that's in that book of 100 bags. There's very few traits, but there's one. They tend to have companies that are founders. They have a lot more momentum to do well than others, and there's quite a few. And amongst those 100 baggers, there's quite a few that were founders, and a large chunk of the shares were still in their hands. So yeah.
And I think ultimately, when he gets to sort of like 50 million turnover in 5 years, etc., I actually think somebody's going to buy them because they want to expand into an adjacent market. It might be Adobe, it might be Open Text, it could even be one of the big ERP players, somebody like SAP or Oracle or even Microsoft, so because it's a perfect adjunct to what they currently do and gives them differentiation when they want to sell their bigger system. They can go to the likes of Coke, who might use, Microsoft could go to them if they have this business and say, actually, we can lift and shift and give you everything that you need, and wrap it all into one big package. So that's why it becomes a bit of a sort of like one of those Trojan horses. It's a unique differentiator that people can get with real contracts. And what was also interesting was that the culture he's building within his company, the people he's recruiting, he was saying that's really, really important when we integrate the new sort of sales team in, that they see the values of the actual business and what we're trying to do. So he's very conscious of what he's doing. I love the company. I think it's great. Love it.
Yeah. So yeah. That's so sometimes that can benefit you. The lack of liquidity can benefit you sometimes, because you buy a little bit, it'll go up a little bit. Okay, you can't get any more, but at least your first tranche is in profit when you try and buy the next bit,
Yeah, so, and then also, basically that Reg S status will fall away in April. On that 12-month anniversary, it won't exist. So you'll be able to get it on Hargreaves Lansdowne, which wouldn't be a problem, and HSBC and Barclays and all these.
And
other
I think
ones.
IG as well would do it, because all you got to do is filling. I think is it W8BEN form? I think it takes a couple of minutes online. That's what it does to show you're not a US citizen.
Yeah. I don't think you need. I mean, I'm not sure you needed to do that, but maybe yes, you would have to do.
No,
it.
I did because I did for this particular company because I couldn't.
You would do.
I kept sending her a quote. And I was on the phone to the lady, and she needed to fill this form in. She took me through it. It took literally a couple of minutes or so. Anyway, one of my stocks. Do you see the update today?
XP Factory.
XP Factory.
What the shares done? What are the shares?
Well, they're up like 10%. It's ridiculous. It should be up. I mean, in a decent market, a bit more than that. But and they've been treading water. It's not a bad thing. But there's an H1 trading update. Everyone's talking about the cost of living crisis, and because they're very quiet to XP. They don't come out and boast about things. You can see social media, boom, battle bars are busy. You can go and experience it for yourself. They're busy, but they don't really push a lot of news out there. I wish they would a bit more, but nevertheless, H1 trading update. Everyone's starting to sort of say maybe the cost of living's hit them. I don't think so. Group turnover up 131% to 18.8 million, and they are a 30 million market cap. That's first a double-digit like-for-like sales growth of both Escape and Boom Battle Bar. I mean, owner operated site level EBITDA up 245% at 3.8 million. As continued high ratings, they got record pre-bookings for corporate sales, which provides this confidence underpinning the full year expectations. And they said, record levels ahead of internal expectations, and literally they are. So I look at the broker forecasts now, but they're trading on a 5 times next year's EBITDA. That's all, and they're growing very nicely.
What was really encouraging actually was Escape Hunt was actually their shining light, wasn't it?
Well,
that
it's
was
good
with all
margins,
those corporate bookings. They're doing really well. That's a real differentiator for them.
Yeah, and it's not obviously, escape and food and beverage, and some of them are in shared locations anyway. But of course, if you look at escape, there's not a lot of spend. Once the spend's gone into the modular games, it's there for years. And they look at the old sort of the older sites are continuing to perform. People say, "Oh, will you get tired?" But no, the average site has about 6 different themes in it. So it's like you can go bowling, once, twice a year. Don't get bored with it, but it's got 6 different games in it, and virtual games as well, which you can change. So once the spend has gone into them, the margins are very good, because there's no more spend needed. So yeah, I just think these will continue to do well. It's one of those things where I said before, younger generations seem to want more now. My kids, looking at TikTok all the time, they want to be entertained every second. And whereas us old fogies were kind of happy to sit in the pub and do nothing, in this day and age, they want to be playing a game, And also, I learned this from a nephew, saying that when you go into Boom Battle Bar, it's a way of breaking the ice with the, people.
I'll tell you what you should. I'll tell you what you suggest. You should suggest to the CEO there, Justin. It would certainly get you and your family in. Will be to put sort of like internet screens with all the stock prices in there, and to have some stock tipping sort of like sort of conversations. That would really bring us all in.
I know.
The coffee shop. It'd be like the coffee shops originally of the stock market, won't it? With the Boom Battle bars.
I suppose that generation go in there, they're targeting, have no cost of living crisis, but they're more into probably crypto, I suppose. But there we are.
Another one which came out. Another one which came out with good news for me, just on the was Eleco soft, the build tech and project management software platform. And I know I keep using analogies, but I will do on this one as well. I mean, I think it reminds me very much of Sage or Aviva, not the insurance, but the Aviva, which was taken over by Schneider Electric a few years ago, because it's moving now to effectively an all SaaS model for its for its software. It's gone from a few years back from 50%, and now it's over 70% of SaaS revenue, and it's reached that tipping point, and the shares have ticked up from 70p up to over 80p. So I think that was on a really good track record. And the reason why I mention it, because once you get to that sort of 80-90% SaaS revenue, you justify a sort of 4 to 5 times sales revenue, and these are still on sort of 2 times sales. Plenty of cash, in the balance sheet, and they may not be going to grow as fast as Fadel Partners, because I think they're going to grow high teens. I think these ones could go double digits, could go 10-11% organic. Plus, then you've got some M&A, and they made a good acquisition as well. So I'm delighted, and I've held these and not sold any, since 2015, so 8 years.
They play, because they've had
there you go, through thick and thin.
No, I know because they had a cracking rise from December 2020. Like, it went from 77 pence up to sort of 147.
Yeah,
and
exactly.
They come back down to like sub 70 pence.
And I've just held. You might want to call me a mug, but it's
no. But let me say one thing. I'm reading the original book. It's a book called 100 Baggers, but it's based on an original book by this broker called 101. And there's a financial advisor story in there where this guy wants to do a will. An old guy comes in and he said, okay, puts all his, he wants to leave things to and all that stuff. He said, right, I need the net asset value. He said, and he's quite vague. And he came in a week later with his son. And this was, I think it was in the 50s or 60s, I think it was. And he came in with his son. And he said, Mr. So-and-so, you haven't told me, what your net asset value was, and a breakdown of that. And he looked at his son, this old guy, and said, shall I tell him? He said, well, you've got to make a will there, And so he said, okay, you give him a piece of paper, and on it was $15 million. And the financial advisor went, how did you get all this? And his son said, he buys stuff, largely stocks, and never sells. So literally, he said, you have a couple that go bust, but by and large, and he held like IBM or something like that for when it was first started and all that. And so, the thing is, if you want mammoth returns, you've got to prepare to say, okay, it may go up, say 50%, come back down, or 100% go back down. But if you want mammoth returns, you've got to hold, and the average length of 100 bagger is 26 years. So it is about, you won't discover that mammoth return unless you hold on. But having the fortitude to do that is good, because I can't. If I see something coming down like that, and I doubled on this and I was coming back down. So I'd have to take some off, right? There we are.
That's happened to me many a time, but hey, such is life. I mean, look, there's the other ones. I've got some big caps just quickly. I mean, again, to continue the sort of analogies, I own Bristol Myers and Pfizer, as you know, and they came out with quarterly results. Both of them, well, Bristol Myers were lower than Wall Street expectations, and Pfizer was in line with expectations. They're both down compared to where I bought them originally. But the analogy that I'd use is, I actually think they're refreshing their pipeline. The investment thesis is still very much intact. They trade on sort of like anywhere between, well, I think Bristol Myers on about 8 times PE and Pfizer's on about 11 times, etc. So really cheap, good solid balance sheets, generating shed loads of cash, but they're refreshing their pipelines. And this reminds me of AstraZeneca about 8 years ago, because they had the same problem. Everybody was asking, where's their growth going to be once they go through these sort of patent expiries? And I think they're going to do exactly the same. Give yourself sort of, you know, an AstraZeneca then was about 35 quid. It's now trading at 110. And I think Pfizer and Bristol Myers will do the same. Look at push the clock forward 5 to 10 years, etc. And I think these are going to have tripled because they're going to have a re-rating, and they've totally refreshed and invested in their pipeline of new drugs in oncology and all the various areas. So I wouldn't. It's one of those things. Yes, they're cheap when I bought them, and they're cheaper now, which is like a bit frustrating. But actually, the investment thesis is still intact, and that's how you decide whether something becomes a value trap or a value play. And I think these are firmly in that value play, because they're not scrimping and scraping and worrying about the short terms. They're investing in their pipeline, and that's how you refresh it. And that's exactly what AstraZeneca did. It went from being a home oncology player 8 years ago into one of the top 3 players worldwide. You know, there's Merck, there's Roche, and then there's AstraZeneca. They're right up there. So, and I think both of them will do the same. So, yeah, I mean, you just got to go through short-term pain. I mean, I've lost, 6-figure number on when I add those two together, which is a painful process, but that's just part and parcel of the rough and tumble of the market.
Yeah, they always recover those big stocks, do they? Generally, it's like
they don't always.
Not always, but when you're like that, one of the big players, and in fact, maybe they'd be interested in companies with infection prevention drugs at the end of that, because Destiny Pharma have an excellent pipeline. I don't know if you've seen the news since you've been away. Literally, Destiny Pharma is sitting on for a while.
Have you been talking about them much recently?
Oh, not at all. The thing is, I genuinely think there's all kinds of, potential risks and rewards and kinds of risk profile stocks out there. And of course, if you want, 5, 10 safe % a year, you go for bigger cash generating stocks with, visibility, all that, paid dividends. Particularly, I've got a fund that holds those kind of stocks, dividend paying stocks. And I look for some smaller cap stocks and micro caps, nano caps that excite me and that can be genuine wealth creators. And if you look at, I've been saying for a long time also, when the share price goes against you, question your judgment, and I think, and I was looking
that's important. It's important you do. It's important you do all the time. Yeah, I mean, and that's a good sign, that is, Justin.
Yeah, well, for a long time, look at Destiny Pharma. This is insane. What they have is insane as a valuation. It just doesn't make any sense. And I say, they got, like I've said, they've gone through on 2 of their assets, phase 2 data. These are in humans, really good standout data that beats current market, incumbents there. And they've got a partner on one of them, and the second one coming up. And I thought that's double the opportunity, the first one, and yet. And it just is a $2 billion market opportunity. The second one, and
only
even
2.
on the first asset, yeah. But listen to this though. But so XPF, which is yet not partnered, okay, that's got more than double the potential of the first asset. 3 brokers are giving a 286 target on that. So and the pipeline. So this is without saying, and it's not an oil and gas stock where there may be 1 billion barrels of oil down there. They've got to find it based on seismic data, and generally, 5 times out of 8 times out of 10 they don't find it anyway. This is like drugs they've tested in humans and going back to test tubes to animals. Everything. They got amazing data on it. The market potential is there. There's an unmet medical need for it. It's better than the incumbents. These are literally, as far as they've got cash, by the way. And then all of a sudden you think the share price is grinding down. The CEO left. I thought, what is going on? I don't understand, because there's other companies out there with one asset. It's not even oncology, cancer. It's not super complex. This is infection. It's been tested. It does kill these bugs.
I mean, so, okay, Justin, just to stop.
One thing. And I thought, hang on. I got really annoyed with it, thinking people are not seeing the value. It was like 25 million with 10 million cash, and then a new CEO comes on board, and those companies you mentioned there, AstraZeneca, GSK, UCB, he's been chief operating officer of many of those. Right. Okay. So here's a guy that seems to. He also was CEO of GW Pharma, which was taken over by Jazz Farms. It was for 7.2 billion. You know, what a 7.2 billion stock on AIM. You know, and literally when he came in, and 6 months after that, Nasdaq it went up to that. And I thought, and then you got Sir Nigel Rudd come in as chairman, and he says, "I've never been a chairman of a company which I've left, and the share price hasn't been higher than when I started." And right now we got an excellent board. Why are they on board? Because the assets are very good, and I think now they're going to start to generate. But even data coming out recently on their pipeline, which is from the XF platform, not the XF nasal, XF dermal for skin infections, is phenomenal. 100 times better than the competitor, and using a concentrate 10 times less. So it's a phenomenal platform assets they have. It's just sentiment's been hit massively. But when that sentiment hits, you question, is this what I think it is or not? But now I'm realizing now it's rallied.
Okay, right. I mean, I'm an independent. Yeah, I don't own the stock, right? The actual reality of the situation is, to me, it's unfairly undervalued because everything in the small cap sector is undervalued, and anything which is considered more risky is more seriously undervalued. So as long as you put that Destiny Pharma in that bucket in your portfolio, that it's a higher risk but an enormous potential upside if this comes off, you're going to be fine. But on a risk reward basis, if you looked at it on an alpha, it's huge. It's absolutely huge because it's so unfairly valued compared, even though it's got a higher risk. And if they get anywhere near where they think they're going to get to, it's going to absolutely soar. So, but it is higher risk, as in, like,
but exactly.
That's the reality of the market at the moment. It's not prepared to take, not even prepared to take sort of like, modest risk. And so anything considered as higher risk, it's going to really unfairly undervalue. And that's all it is, Justin, I think.
I know exactly. I mean, even just based on the one asset, which is completely ignoring their bigger asset and the platform, this has got 600% upside, right? Now, if you add in everything else, you're looking at probably 10 quid more. That is a 20 bagger. Now, if there's room in your portfolio for a little bit of this, because that's the excitement of the AIM market. But of course, and the thing is, but if it does pay off, you only need one of those.
I know.
Need one of the. So you're talking about putting $1,000 in, getting 200 grand back. So that's all you need is one of those. And yet it's not as if they're so far off from commercialization. They say the data they've got, they're going into phase 3. One is partnered; it doesn't cost them anything. The other one, they will fund a partner. They get a bigger upfront payment, which enables them then to progress the other pipeline, which is like. It has rallied nicely. I see people taking profits now. They're thinking, are you kidding? If you looked at the potential, it's like, with Eleco, you didn't take profit there. People are taking profits because it's risen by 30%. No, don't take profit yet. Don't. It's one of those things that don't have too much in because you get nervous, but have enough in to make a bit of difference. Because if it doesn't achieve anywhere near its potential, it can transform your portfolio. And
I mean, that won't just move the dial of your portfolio; it will blow the flipping clock off the wall. It does.
So it's one of those things where don't go crazy on it, but do some research and realize it's for where they are and what they're quite low risk compared to other biotech farmers that have one asset in phase 1 or whatever that. It's they're nowhere near that. They're way in advance of that. So, like I said, I see other people playing oil and gas plays. I've seen so many people who just into oil and gas, and the amount of dusters they have, and drills didn't happen, and all the odds of striking oil and gas are like 5 to 10 to 1. Those are not odds you should mess around with. If they are, you shouldn't have less than 1 or 2% of your portfolio. This is not that.
And the other thing to remember is not only is it sort of higher risk and massive upside potential, but also the whole healthcare and biotech sector is definitely out of sorts with investors. I mean, I've got to give you 2 others just quickly. I mean, you've got, Belluscura. They signed a major distribution deal out in the States. These guys we've talked about portable oxygen concentrate. They signed up McKesson, who are the world's largest distributor of drugs. But they've got basically, they deliver everywhere in North America, and that's their partner for their older model, the Explore, and I'm sure they're going to sign up as well for their Discover going forward once that's actually available. So, I mean, that is just enormous. That's fantastic distribution. You just cannot get better coverage in North America, the world's biggest market, and the shares are on their knees. It's just been totally flattened. And another one with a lot lower risk is Venture Life, which does though, OTC healthcare, sort of products, etc. Came out with inline trading update, and shares are still very much sort of ho-hum. They're trading on about sort of 6-7 times PE, and they're firmly on track. And the good growth in the first half, double-digit organic growth, and improving EBITDA margins as well. So everything's and reduced net debt also. So everything's moving in the right direction. And the shares haven't moved. So the whole sector, healthcare sector, even if you're at the higher risk spectrum, which is Destiny Pharma, or the lower risk spectrum, which is already generating cash and revenues like Venture Life, they're still on pretty low valuations, and that's the opportunity. You've seen it, you've put your money into it, and so have I. I mean, Bristol Myers and Pfizer to be on PEs of high single digits is nuts, absolutely nuts.
I know. Well, once some of these question things like that, and I say question another one I say like that is a lot safer, but I can't understand the valuation is Good Energy. So they are profitable.
Oh yeah.
They're the only now energy supplier, the only one with a 5-star rating on Trustpilot, and they just come out with about how efficient their gas. Their heat pumps are literally 3 times the amount of energy you get out than you put in, and they're a lot better in gas boilers and all that stuff. But it's like they got 19 million in cash, they're like 30 million market cap. You're thinking, what? And yet they are within that space. It's going to get. It's only going to get busier. Heat pumps, solar, supplying renewable energy. It's only going to get busier. And so, but sometimes that's it. Some people, I'm sure, lots of people, invest in these opportunities, get bored, think, no, I was wrong there, obviously, and get out, and then realize I've done it quite a few times actually, got out. So lack of patience, and the share price has gone up like that. I'm not going to make that mistake again.
I mean, just as a customer, right? I mean, I've got 2 heat pumps in my house. I've had them, and they're brilliant. They're dead efficient. They give you aircon in the summer, and they give you heat in the winter. I mean, and they've got a lower VAT rating. I mean, what's not to like? Brilliant. I mean, I couldn't. I mean, I've had them for 15 years, and they're perfect. Just keep knocking it out, getting service once a year, and they work an absolute treat.
You're ahead of your game there, Paul. And
well, there you go.
Wow.
Don't know about ahead of my game.
Yeah.
I mean,
anything else?
Another one I would like to talk about, because I know certain investors have followed me in on it, is PayPal. Now they came out. I mean, this is again shows out the nuts of the market, right? They came out with their earnings statement a couple of days ago, in line with expectations with Wall Street, top line and bottom line, and they reiterated their guidance for the full year. In fact, they said they were going to be slightly better in Q3 as well than the Wall Street were expecting. So that was all good on that. But the shares sold off.
Well, they gapped down.
They sold off about 3% on the day, because it must have leaked out, and then they sold off 12%. Yesterday as well.
Why?
Exactly. And so you look at it and you just think, okay, well, that's what the market is. They're indirectly they're expecting more, and the fears that they've associated with is essentially they're growing so fast in their third party payments platform, their Braintree platform, that's damaging margins. And yes, it's damaging margins, but I think this is exactly the right strategy. So yeah, they came down. I mean, again, you lose you lose a 6-figure number on a day, and you think, okay, well, that's what the market does, So but that's not a problem, because that's part and parcel of what you do. You've got to, whenever you get something which falls down like that, you've got to ask which you do and I do, is this a value trap or is it a value play? Is it worth holding, or should I be selling? What's the reasons for the actual sell? Does it break the investment rationale, the thesis that you did? And I certainly don't. I still think they've got a good balance sheet. They're growing well, high operational gearing. They're going to continue to take out a shed load of costs. And if third parties increasingly are using their platform as the payment rails, then that's brilliant, because they do all the heavy lifting. It gives you economies of scale. And it basically just pushes the profit straight down to the bottom line, because people don't. Then there are switching. They can switch out once they've signed up, but there are big switching costs as well, because your customers get used to using that payment and they like it and they don't want something else. So there are barriers to exit. There are switching costs associated with it. So I've got
PayPal all the time anyway.
They've got 400.
I'm helping. I use PayPal all the time.
Well, there you go. Exactly.
The missus use it too much.
Yeah, well, there you go. So I mean, and that's trading at about 13, 14 times. And I just think, again, it's another asset that'll get probably bought out, maybe by Microsoft or somebody else with the fullness of time, if it doesn't sort of like, if it just stays at these sort of levels. But again, you've just got to accept, if you're buying stuff that the market doesn't like, and this is clearly the market doesn't like, as we mentioned with Bristol Myers and with all the health car and Pfizer, then it takes time for sentiment to change.
It's amazing how fast sentiment can change as well, though. Because I remember a time when, do you remember people were hating on Facebook and all that? And literally, if you got in when people were hating it, you'd have done 100%,
Yeah.
70. So it's a lot of that. It's buying stocks and good businesses that people have hated the moment. They don't like them. Out of love with them. And the sentiment changes.
A year to 2 years it can easily take, and that's just one of the things. And so, hey, and that's a short time holding for me. My average holding period is probably 3 to 5 years, something of that sort of level. I always go in with that type of sort of mentality. And if I've still got PayPal and Pfizer and Bristol Myers in my portfolio, then 5 years time I'll be delighted, because they'll be doing really well.
There's a fund in that, Paul. Hated good businesses. That's usually a fund.
No, exactly.
And literally, these businesses are hated, but they're great businesses.
What an idiot.
Marvelous stuff. Cheers.
Okay, well, I'm looking forward to hearing your 2 stock picks next time.
Yes, I think you'll like them. And they are, literally groundbreaking and small. UK, sorry, one is US, UK, but I quite like them a lot. I think they're in good areas, and but I think you've covered one of them regularly. So
good. Well, you definitely whet my appetite then.
Yeah. In fact, do you know what? It was your interview that I saw with this particular guy. I thought, what? Did he just say the target for how much they're going to do? I thought, what? I did the figures on a lot lower, and I saw excellent upside. I thought, if he's doing that, that's phenomenal. So anyway, cool. Speak in a couple of weeks.
Take care. Cheers, Justin.